dollar strong relative to other currencies. But that doesn't mean that, let's just take something like the euro or some other obscure, the pound or whatever. Still, traveling to London today as versus 5 years ago is going to be vastly more expensive because the dollar is weaker in terms of all goods and services all over the world. It's just that the exchange rate between the dollar and these other currencies makes the dollar look relatively strong. So you're going to have a more powerful spending experience in London today than you did than you would have 3 years ago if you're using dollars rather than using pounds. So that's the way it works. I mean, that's how you can have a strong dollar that's actually being devalued all the time. So I think that this is just too many steps of thinking for most people. That's why they get confused about it. I think we're going to continue to see these long, slow declines of the value of the purchasing power of the dollar. Now, in terms of its status as an international reserve currency, wow, that has been shored up over the last 2 years, really, and in ways that I didn't expect.
More than 60% of global trade is still conducted with the USD, Jeffrey.
And I haven't looked at the data recently, but it's most likely probably rising, and that's just simply because, as bad as our central bank is, it's been able to get away with a lot more quantitative easing than any other central bank in the world, precisely because the U.S. has the advantage of being the world reserve currency. And I assume that we've got a lot more years built into that. That's going to continue to be true. Even if the dollar continues to lose purchasing power in terms of goods and services domestically and really all over the world. So you just don't notice it much because our competition sucks even more than we do, basically. As far as we can tell, residential real estate right now is a market that's completely frozen. It's hard to draw these curves any steeper than they are right now. And I'm not just talking about Federal Reserve statistics, but industry statistics. I mean, basically, you call it a buyer's market if there were any buyers. It's really been an incredible disaster. I mean, and think how quickly this happened. It was only about 14 months ago. When you whispered to your neighbor you were thinking about selling your house, you had 10 people lined up at your front door ready to buy, outbidding each other, right? And that was 14 months ago. And now, those same people just finally got around to patching the holes in the wall and vacuuming the carpets and putting it on the market. And now there's no takers, right? So the whole market's been frozen by the Fed's federal funds policy, which has just driven up mortgage rates to 7%. I expect them to go to 10 and higher, and so there's absolutely no hope right now in residential real estate.
Jeffrey?
Well, they can't afford them. They can't afford them at 7, right? So, but that's where they're headed. That's what's going to happen under Powell's policy. We've at least got 3 more 75% basis points of increase in the federal funds rate, and those filter through the yield curve to hit mortgages. And that's where we're headed. Now, what's interesting about this is that it's going to look very different from 2008. Right, we learned what it meant to have carrying a mortgage and have a house underwater at the time. What that meant was that if you put it on the market and then rebought the house yourself, you'd be way better off than you are just doing nothing. Right? I mean, because it was much more. You're holding a mortgage that was worth much more than the house could sell for. Now today, but that weird situation in 2008 happened only because interest rates were so very, very low, and that's when everybody's refinancing their homes and trying to take advantage of the cheap credit. That's no longer true. So offloading your house now would embroil you into a mortgage situation that's very likely worse than what you have right now. You bought your house at 2%, and now you're gonna rebuy it at 7 or going on 8%, 9%. No, that's not going to work financially because these interest rates highly affect your monthly payments. So we're not going to see houses underwater like we saw in 2008. It's going to be a very different thing, which is just going to be people will be trapped in their homes and grateful that they locked in the rates they did when they did. I was listening to Peter Schiff the other day. He seems to know a lot more about these mortgage markets than I do, but there are people out there with these trigger rates, these flexible rates, and they're going to be hit very hard. Now, the credit card problem is very interesting too, because you've seen, as you saw from the latest data, people keep ramping up their credit cards to try to, maintain their lifestyles in the presence of real falling incomes, and relying on that plastic. But credit card interest rates are hitting 17%. They're going to grow and grow. So, that's going to amount to a serious financial squeeze for a lot of people that have been, not used to paying off their balances every month. They're taken in by these revolving rates that at some point was pretty affordable. They got into very bad financial habits, and that's going to be good torturing them over the coming 12 months. That was the last time that we did a Volcker, to the inflation rate, and used, high interest rates to crush embedded inflation. It worked, but it also caused immense pain over a very long period of time. 4 years would be a good example of that. But if you go further back in time, the Great Depression, which every financial crisis looks different, by the way. You can learn from the historical experiences, but not expect them to be repeated exactly. But what began in 1929 really did last till about 1948. So, and that included a ghastly war. So, if we can get out of the present situation with, a solid 4 years of very low growth or negative growth without a financial crisis at this point, I think we would be very lucky. So far, we've avoided that financial crisis. So if that starts happening, and there are a number of triggers that could cause that, then it could be a real mess. And one of the things I've learned over the last 31 months is, you should be prepared to expect something that's far worse than you ever imagined. I mean, that is the lesson I think that we've learned over the last 31 months. Like I say, I don't know how much of the markets have absorbed the monetary profligacy over the last 30 months. I don't, it's hard to say. Have we done 10%, 20%? Are we over the 50% mark? I don't know. We don't have zero prevalence studies to be able to measure, whether, but all that money has to become endemic. And keep in mind, we've been through these kinds of bouts before, like 2008, but all that money was locked away in cold storage. This time, they threw it hot on the streets, they dropped it from helicopters, and we just really haven't been here before. So there's a lot of repressed inflation out there that really needs to express itself in higher prices. And you're also starting to see some dabbling in some forms of price control. I'm sure you saw Biden's, angry denunciation of airline fees for baggages and restaurants that are adding service fees onto bills and that sort of thing. So if you can't do that, that's a form of price control.
Yes.
So I wouldn't rule out, if things start headed in the wrong direction, that this administration, this government would toy around with price controls too. So that's a real possibility. Like I say, I think we need to be prepared to expect the unexpected. I've been in the space for a very long time, and there's been a kind of doctrine, that has been alive for a very long time, which is that it's a very good technology. It's better than public money, is better than national monies. It performs much better. It's more secure. You can't censor it. It's, fast and cheap, and, all these claims. And therefore, and this is where the problems come in, the price is going to rise forever because there's a limited quantity of it. Okay, that's not a bad prediction, but it's not by any means baked into the cards, nor is timing necessarily part of that. So what happened over the last 3 years or so, or you might even go back further in time, is that many people in the crypto space confused higher prices with an affirmation of their predictions that it's headed to the moon, that we're going to $1 million. What was actually happening is that crypto was partaking in a general financial bubble that was taking place as institutions got into it and started believing that it was a valuable asset. And started basically moving with the financial markets, and that I can't put a precise date on it, but it started happening certainly 2 years ago, or maybe 3 years ago. So I'm not sure that people in the crypto space really understood. So there is an impression somehow that there's, that Bitcoin and its related cryptocurrencies were immaculately conceived, like holy entities that were somehow exogenous to, all of public life and would move independently from your normal booms and busts in financial markets.